I think on this theme of potentially elevated volatility in bond markets, it's not just bond yields and how we manage duration that will be important. We've also seen lots of volatility in terms of yield curve slope. So big moves flatter and in fact inversion in the yield curve, and then shorter periods of re-steepening. And away from curve, we're now starting to see some volatility in currencies as well. More recently, we've seen the US dollar weaken, and I think this is the beginning of a potential trend in the dollar. As US growth reconverges back towards rest of world, we should start to see some reaction in currency markets. And these banking headlines, they have created volatility in credit spreads as well. Now, we need a flexible strategy to take advantage of all these different risk premia across fixed income. So building on duration management, including country selection with emerging markets as well, but also looking at yield curve risks, looking at currencies and taking spread risk is something we need to do to make the most of the opportunity set out there for fixed income this year. This is a strategy and a team that don't just focus on a structural risk, such as being long credit for all of the cycle, or chasing yield in a certain direction, be it high yield markets or EMD. We only allocate to those asset classes opportunistically when we think we're getting paid for the risk. Instead, by focusing on more macro sources of return, we have that differentiation versus peers, and we also have scope to look at a very broad range of opportunities to help deliver excess returns within fixed income. I think having a broad basket of return drivers is really key in running a flexible strategy. Well, I think this gets to the point that investing on an inverted yield curve certainly has a yield challenge. So we know that buying 5-year government bonds or buying 10-year bonds has a lower yield than cash currently. It can be up to 75 bips or even 100 bips lower than the cash rate. So we have to ask ourselves the question, do we really expect positive price returns from fixed income this year to help compensate or offset that yield challenge? Now, I think with the carry that we can embed into our portfolios and some of the use of credit or EMD to help offset that yield drag, we can still get to a competitive yield. But at the same time, we have a strategy that has lots of potential upside. We've seen in some of the recent banking headlines just how violently yields can react to bad news. US Treasuries fell up to 100 basis points on some parts of the curve. So by looking at a flexible fixed income strategy this year, you give yourself lots of potential upside if the market becomes constructive. You don't really sacrifice that much yield relative to a cash rate.